My name is Jack Hanney, and welcome to this week's edition of The Insider. As Jerome Powell and the Fed last week decided to hold rates and not cut rates, what we're finding is a lot of volatility in the stock market, with the jobs report last week posting an abysmal 73,000 jobs added in the month of July, and then the revision downward on the previous 2 months jobs report showing that the labor market is not only cooling, but unemployment is ticking up significantly higher. Now, when Jerome Powell and the Feds opted not to cut rates, what we're starting to see is cracks in the real estate market. If you look around your neighborhoods, if you look around some of those markets such as Charlotte or in Florida, some in Texas as well, where a lot of people moved during COVID, there is just a flood of inventory. What we're seeing is for sale signs popping up. We're seeing home prices starting to decline. We're seeing homes sit on the market for months longer than they were previously. And this is due to the interest rates being so high. So what we're starting to see is significant cracks in the residential real estate market. Meanwhile, gold is holding steady above $3,300 an ounce. There's now support at $3,300 an ounce, and silver is powering its way to $40 an ounce. Silver has been up $38, $39 an ounce for the past week and a half, and that's regardless of Jerome Powell and the Feds not lowering rates. So rates with high as they are right now is typically headwinds for gold and silver. But once we start getting into a more accommodative rate cutting cycle, those are significant tailwinds for physical gold and silver. I am not a certified financial planner, nor do I give tax advice. You can visit us at www.patriotgoldgroup.com or call 1-888-301-7012. Again, that's www.patriotgoldgroup.com or call 1-888-301-7012. Start looking at the labor market, the real estate market, as well as the volatility in stocks. The AI spend on the Magnificent Seven stocks is not enough to keep powering the NASDAQ and the entire stock market higher, with interest rates as high as they are and our national debt as high as it is. Anyway, thank you, and I look forward to speaking with you next week on an episode of The Insider.